if you don't know truly then what the bias is anymore from the Fed, then what investment decisions would you make as a result? And would any of your prior change as a result of the ambiguity you're seemingly suggesting exists today?
We've been, for a while now, operating under the investment theme of higher for longer from the Fed. And higher for longer means that you can expect very good returns out of certain parts of, say, the fixed income market. Like today, BB bank loans, I've talked about this in past appearances, BB bank loans are very low risk, and they have a spread that is about 290 basis points over SOFR. So you're talking about yields with an 8 handle. So even if the Fed cuts once, twice, you're still talking about something that is very attractive, and the risk is very, very low. And I think that what I take away from Powell's Q&A today is that you're probably going to be earning that 8-handle yield for a while now, and the default risk is very, very low. So the bond market has been incredibly stable. We've seen the yield curve at negative 45 basis points or so, 2s, 10s, and it's still there. With all the gyrations that we've had, we had the 10-year Treasury go from 3.9 up to 4.8. The yield curve didn't move 2s to 10s. I mean, some days, but on a trend basis.
Sure.
And now we've had the rate come all the way down to 4.25, and it's still at that level. So the market seems to be saying, I don't know what's going to happen either, but we're biased to think that the economy is going to weaken, and the Fed, on the margin, is more likely to cut. But I think the odds of cuts obviously went down today, because when you go from 3 to 1, that's newsworthy.
Then why is the equity market, do you think, reacting the way that it is? We're likely going to put in new closing highs for both the S&P and the NASDAQ once again.
Well, yields are down a lot this week on the 10-year. That's spurred things. The inflation data today doesn't hurt at all. The stock market really needs rate cuts, I think, to sustain, or they need the earnings projections for the coming 12 months, which have been upgraded. I think that's helped a lot. They're up about 14% now for the S&P 500. That's a big number. And I worry about that, but that's in the psyche of the market right now.
Does it need the rate cuts, or does it need the belief that there are going to be eventual rate cuts? And frankly, nothing that the Fed chair said today leads you to believe that the next move is not a cut, does it?
No. The overall takeaway from today's meeting and press conference has to be that there's more like odds are that the next move is a cut. But those odds have gone down. And I also think that I'm just going to repeat this. I think the rhetoric from the Fed is going to change fairly dramatically between now and year end, because I don't think this data is going to be sideways to the extent that it has been. I think the economy is going to be weakening. I think employment's going to go up to 4.4, and I think that's going to be enough to change the way they're looking at things. But when we started this year, I remember the pricing in the bond market was 7 cuts this year. Can you believe it? 7 25 basis point rate cuts. That just seemed crazy.
Feels like an eternity ago at this point.
It seems almost impossible people could have thought that. And yet the bond market hasn't really changed very much this year.